This idea that a bear market rally is still possible, whereas you do have some calls in the market saying perhaps the stock market is bottoming out. What's your take?
So they say that markets move on better or worse, not good or bad. And there's a lot of pessimism priced into the market right now, whether you're looking at surveys of retail investors, fund managers sitting on their highest levels of cash since 9/11, economic surprises bottoming at the levels that we saw during the early days of the pandemic. So when we think out over the next 12 to 18 months, we think this is going to end up looking back as a nice entry point for the stock market. At the same time, we have to have the humility in the short term to recognize the fact that we're dealing with a couple of factors: war, inflation, things that most investors in this market don't have a lot of experience with. And so what we're doing is staying patient, we're staying diversified, we're focusing on quality, but we are at normal levels of risk in our portfolios.
I love that you said that most traders, most investors don't have that experience. As a journalist, I certainly don't have that long kind of vision. But I have to ask, does that really matter in this environment, given that over and over again we're talking about this being unprecedented, and also we knew inflation was coming? This was something we were talking about, say, even a year ago before the actual consumer felt it.
We did know it was coming, but I think that we didn't realize how long it would last and how high it might persist. And I think that's one of the challenges that investors are grappling with at the moment. I think the reality is we're watching signs inflation is going to be the number one thing on people's minds. And it's not necessarily the absolute level, but it's signs that things are beginning to roll over. And to us, we actually think that inflation signs are going to begin to ease, whether it's easing of concerns in the labor market, wage pressures are beginning to abate. The economy is shifting from goods-based consumption, which is where a lot of the supply chain bottlenecks exist, to more more services-based consumption, which is where there's less inflation pressures. And then we're obviously seeing some cooling in the housing market. So three of the big factors that are contributing to inflation right now, we think are going to begin to abate, and I think that's going to make investors happy.
Well, that's good news, especially at a time when the stock market is hearing a lot of the words recession, is hearing volatility. Is the fact or the idea that recession is inevitable in, say, by the end of the year, this contraction of the economy, well, the economy is still growing at, say, 2%. Are those fears completely overdone?
I don't think they're completely overdone. We certainly think that the risk of recession is higher today than it was when we came into the year, but we don't think it's as high as what markets are reflecting right now.
Just to interrupt there, what is the driver? What changed that? Was it the war in Ukraine?
It was a number of things. The persistence of inflation, the war in Ukraine, some of these structural factors related to inflation, which ultimately led the Fed to have to take a more bearish stance in the way that they're approaching raising rates. I don't think markets were prepared for how aggressive they might need to be. The good news is that the markets have done a lot of that repricing for them. Financial conditions have tightened. Rates at the long end have gone up. Mortgage rates have gone up. So I don't think we're going to need to wait for the Fed to finish hiking rates for markets to be able to recover. But it's going to take a little bit of time and guidance that that there is a soft landing potential.
Well, let's go where you took me right where I wanted to go here, and that is talking about the Federal Reserve. We can't have a markets conversation without that. We've only been in this kind of quantitative easing cycle once before, and a hiking regime that kind of counters that. 2016 through 2019. And during that era, the stock market rallied. If we're going by that precedent, what does the stock market have to worry about when the Federal Reserve is quite literally tackling the inflation that it was criticized for not tackling?
So I think that's going to be good news. And when we see signs that it's working, that's what's going to get investors excited again about the market. I do think one of the things that we have to recognize is the playbook that we've seen for the last decade, which is a slowdown, the Fed's ability to then cut rates and stimulate the economy, is probably not going to come back in the same force that we've seen it over the last decade. So what we're focused on is a focus on quality companies, strong balance sheets. Investors have spent the last 5 years focusing on how much revenue can you give me 10 years from now.
Right.
Now they're focusing on how much free cash flow can you give me today.
It's fascinating that you bring up the cash flow story, because for so long they were trading on liquidity. I mean, you saw one of the most attractive pieces of Apple and Microsoft. It wasn't the fact that they were the fastest growing companies in the S&P 500. It was that they were sitting on billions of cash. I have to ask, though, if you're going from a liquidity trading story to, say, trading on margins to trading on supply chain issues or whatever that may be, what is the next signal to buy into some of these names, and specifically into big tech?
I think big tech is actually well positioned. When we talk to our fundamental analysts, when we go to conferences and talk to companies, while you see headlines around some of these earnings and revenues misses, generally speaking, the message from big tech is that demand is still strong. And I think when you consider the valuation dynamics of a lot of these big companies, it's just going to take time. And patient investors are going to be rewarded for looking at some of these big tech opportunities. We're not as excited about some of those more speculative parts of the market, the high flyers. I think that financing and capital raising is going to become a lot more difficult on the other side of this cycle, and that's why we want to focus on quality. Big tech checks a lot of those boxes.
I'm really glad you used the word valuations, because now one of the major reasons for, or the bull cases I should say, for hopping into the stock market here is that if you look at some of these valuations, they are back to pre-pandemic levels. But if you kind of rewind to January of 2019 or January 2020 and even in the last quarter of 2019, I remember one of the big conversations there being, the stock market is overheated, tech is overvalued, what are we going to do about this? So getting back to those levels, is that really a positive?
You know, I think that when you look at the valuation story, certainly a lot of froth has come out of the market. Unfortunately, when you see market corrections, valuations tend to overcorrect on the downside, just as they do tend to overshoot on the upside. That's why, again, stay focused on quality, stay focused on those companies that are going to be able to grow into those attractive valuations. And I actually think that, you know, staying in a place where we're closer to long-term historical averages as opposed to looking for, you know, the historical highs on the valuation front puts us in a good spot. It means that overall returns on the equity market are probably a little bit lower than what we've seen over the last couple of years, but that's completely normal and a good environment to be investing in.